South Africa's economic growth reached 3.8% in the last quarter of 2013, slightly above economists' expectations, Statistics South Africa said on Tuesday. This is the first time since 1998 that we will have had the GDP data released before the budget. BDFM talks to Arthur Kamp, investment economist at Sanlam Investment Management, about the pre-budget predictions.
I think the key point is that the current account deficit reflects the government budget deficit in large part. So what we need is fiscal consolidation. The government must show a reduction in its budget deficit over time and stick to those numbers, as we have shown in the medium-term budget policy statements. There's going to be significant improvement in capacity at provincial level to spend, and I think quite a bit of that Capex will be spent. But the real growth in capital expenditure is not going to be especially strong, and total non-interest spending is going to be quite constrained, probably running at about 2% in real terms per year over the next 3 years. And the reason for that is that the government has to lower its expenditure GDP ratio so that it can show that reduction in deficit over time and therefore ensure debt sustainability. I think growth is quite constrained. It's a low productivity environment. Global growth is not especially strong, including amongst key trading partners in Europe. So very difficult for South Africa to grow fast in this environment. We also have restraint on government spending. We also have some monetary policy tightening, as we saw in January with the repo rate hike. So I think growth is going to be quite constrained, somewhere between 2 and 2.5% in real terms this year. If global growth holds up reasonably well, hopefully South African growth might show some improvement next year, but not especially strong. We certainly don't have enough savings, and that's reflected in our current account deficit. A large part of the saving in South Africa is government saving. So our savings rate over the last few years has declined quite sharply, and in fact that's been a key reason for the current account deficit widening, and also it makes us reliant on foreign capital inflows. So the Minister will do what he can to improve savings, and one of them would be favourable tax treatment of certain savings vehicles. We're waiting for the final indication of what those vehicles will be. Hopefully that will be shown in this budget. But on margin, really the biggest contribution the government can make is to reduce its deficit over time, as shown in the medium-term budget policy statement. What we need confidence in is the ability of government to actually stick to its medium-term budget policy. So, in other words, to reduce that deficit, to stabilise the debt ratio at not much higher levels than we're currently at, and to show that government is not going to continuously absorb more and more resources that the private sector needs to grow the economy.